10-year would hit 2% in the course of 2021. And I think that's achievable. I think it's likely we could even go above 2%. We could see 2.5%, maybe even sometime over the course of the next 12 months. It's a combination of growth, the inflationary pressures, and if you think about it, the Fed wants inflation and they want higher rates, because even before COVID, the Fed was struggling with the idea of how to avoid having to take rates to zero and introduce quantitative easing to fight, each and every next recession. So what the Fed had done is change its mandate to try to encourage inflation. And so in a way, I wouldn't be fighting the Fed here. I think we will get inflation. I think we'll get a higher 10-year treasury yield. And I think that's going to dictate the performance of virtually all assets in an investor's portfolio, beyond fixed income to equities to even real estate. I think the 10-year treasury yield will be an important variable in determining an asset allocation.
Oh, absolutely. Joseph, good morning. Thank you for joining in this conversation. The Fed also highlighted that they will signal in advance to the markets about their plans for QE tapering. The only point there being, do you think they can ever really prepare the markets? Because we go by the playbook of the past, whether it's taper tantrums of 2013 or even December 2018, the market is in no mood to see an exit policy in place.
Yeah, I think one of the challenges is that we are going to see a change in leadership. And in some respects, we've already seen that in so far in 2021. At the beginning of the year, if one had, if you had said that the markets would be up, but technology would lag, I think you would have received a lot of pushback. We certainly did as we put on our list of 10 surprises in the beginning of the year. But it was really predicated on the idea that the strength in the economy and inflationary pressures would cause the 10-year treasury yield to go higher. It would steepen the yield curve. And in turn, that steeper yield curve, the higher 10-year treasury rate, would essentially punish the most speculative companies. And so if you think about some of these more speculative companies that are pre-revenue or non-earners, it's natural that they would underperform in a higher rate environment, simply because you have to discount those future cash flows. So I think the change in leadership here is one that is going to favor companies that have the ability to either increase prices or benefit from higher inflation. So that's financials, it's industrials, it's energy. Across fixed income, it means shortening duration and looking for fixed income instruments where you can reset your rates higher. In real estate, it means, reducing your exposure to forms of real estate that are bond-like and go with forms of real estate that have shorter durations, like a logistics portfolio.
Joseph, as you talk about rotating out of more speculative plays, I mean, we know you don't have a position in cryptos, but I just wonder if you think that's another factor leading to the decline in cryptos, being the Fed and some hints now, perhaps at normalization on the cards, if this is just part of the story of people taking money out of more speculative bets.
Well, I'd really hesitate to speculate on cryptos, because it's not the way that Blackstone invests. So from my perspective, it's something that I might watch from an arm's length. But I certainly think that you could be right, and your coverage at the top of the show, talking about some of the moves that we're seeing coming out of China to restrict access to cryptos, et cetera, could all be contributing to that sell-off. But really, the bigger picture here is the most speculative assets in the equity space are ones that are pre-revenue or non-earners. And so if you think about a pre-revenue company, it means that its cash flow is more heavily weighted to the distant future. And in an environment where you have higher interest rates all around the world, it means you've got to look at those types of speculative investments very differently.